In the last 2 decades, we have, just from start to finish, a 10-year yield market that is much lower than where it started in 2000, and an S&P 500 market, Pete, that's much higher than when it started. But you would say on any given day, these markets are positively correlated, correct?
Absolutely.
That's
Absolutely.
it. Okay, that's all we need. We just need a one word.
They absolutely. I mean, it's positively correlated. Yes. Is it dynamic? Yes. But we're seeing. It's funny. I've seen this over very short time horizons where you get almost a negative. You don't have this positive correlation, but it's actually a negative one. It's very short-lived and very rare to see.
Yeah.
So what we've seen is this decoupling of that correlation. It has lasted far longer than I think any of us would have thought.
And you can see, especially in these spurts between 2000 and 2015, really, that's kind of when a lot of this correlation broke down a little bit. But then also you see it in these spurts as recent as, the COVID pandemic news breaking out in February and March of last year. Stocks dive, yields dive. And now what we've seen is kind of promoting this question of reversion or revolution, because we have seen this recent divergence. But like you say, there are plenty of divergences. But yeah, follow these lines in 2000 to 2004 here, both descending together. Oh, from 2004 to 2008, bouncing back. And then, of course, the crash in 2008, both of them moving lower together. Now, what we have today is a stock market, like you see here from 2020 until now, that is just boom, skyrocketing,
yes.
Like moving so much higher, and a yield market that tried to move higher and actually has come back in recent weeks to the lows. So we're going to ask at the end of this segment whether we think, and those of you at home think, this is an opportunity for reversion or a true revolution. And a lot of people, especially media pundits online, like to go out there and say, oh, well, things are different and now it's going to be different forever. Few of those people actually end up trading. So we'll see what the answer is coming from us too. But these divergences occur, like you say, Pete, for months at a time. And here I've zeroed in on kind of the turn into the 2007, 2008 crash there, where you'll see, and oftentimes this is the case, like people like you, Pete, who have been around markets forever, will say like, oh, interest rates are usually a tell that something is afoot. Like if something happens in rates, it usually happens before it hits stocks. And you can see from 2005 to the end of 2007, both these markets climbing a couple bumps here and there, but climbing higher. And then rates, this red line, falls significantly at the end of 2007 and into the early part of 2008. And then stocks, they fall a little bit, but really take their time to come down to meet them. And that's where we usually see the opportunity in these divergences, correct?
Absolutely. And you know what? Whether it's a tell, we're always careful using that term tell, but a disconnect between normal working. I guess that's a fancy way to say tell, but that you come to expect relationships, especially correlations, to kind of perform in a certain fashion. When they don't, it kind of challenges your thinking as to, is there a change in the relationship? And I think I love the fact that you went back and added this context, because we talk about, you look at that first slide we looked at, it's like, well, the correlation is tough for me to see. Here, I mean, you can see that correlation, this consistent correlation play through, and the divergences that the diversion we're in right now is one of the most acute, but here you really can see the correlation that plays through this over the longer term. So this really is a very clear snapshot of, when you're talking about yields and equities, how important, how consistent that correlation is over time, but how dynamic it is in nature. And I like the fact you pointed out to me is I don't know if we call it leading effect, but the first mover effect of rates, and then is it the realization or the alignment adjustment of the other asset classes? And it often, here it seems like it makes perfect, that lagging effect, there's the catch up, but it's sitting through that turn. That's the difficult part. And that's kind of where we are right now. It's in that turn.
You raised so many good points there. First of which being that, like, and this is something that I get all the time from people who are new to spreads or new to pairs or just new to combining two markets
Right.
together. A lot of people feel comfortable in, like, I've got my equities over here and I've got my interest rates over here, and they are different and I don't blend them together, and that's fine. But when you do finally put those together and you create these new permutations, these new trades for yourself, one of the first questions that comes up is people are often like, oh, well, I want stuff that's like 100% correlated. And if there's something
No,
that
you
is
don't.
that is well, it
Right.
always becomes like, if those two things are diverging, then I don't want any part of them. They're moving in different directions. And it's like, well, what you actually want is something that is historically correlated, but has imperfections, because
Right.
if it's perfectly correlated, then there is no trade.
Yeah.
But if there's no correlation, then there's also no trade. You want this middle ground, like you say.
Right. This is why we look to that 65 to 80% being our,
Yeah.
and we'll even tolerate a little less.
Yeah.
Because part of the function of correlation breaks down is the divergence drives the correlation lower. So we take
Exactly
that into
right.
account. You can't expect a market to maintain an 80% correlation and show you divergent extremes. Again, they feed, those two numbers feed on each other. So we have to accept a little bit of softening of the correlation when we're looking at the divergence opportunity.
The other piece, the other great piece that you raised there, Pete, is, well, if yields moving lower, interest rates moving lower is maybe a tell for equities coming down to meet them, then why don't I just get really short equities? And that's because while it is a lot of times a tell, it is also maybe more times than not a bump in the road. And so you want to be on both sides of these markets and not just sell equities, because if I sell equities, Pete, then yields can bounce back and equities can continue higher, and then I'm just losing out. But
Right.
if I sell equities and I buy yields, then that means that these two markets can move lower and I can make money that way. Or this can just be a bump in the road. And now we're in the current moment for these two markets. We have yields in red and stocks in white there. If I buy that red line that's turning lower and I sell the white line there, then I can make money if these markets both move higher and yields just bounce back harder, or if they do move lower, because sometimes it is just a bump in the road. And you can see here, I made sure to add data from 2019 and 2020, where you're seeing already in 2019, before COVID news breaks, you're seeing yields kind of trending lower here from 3% in 10 years down to 2%, and then well below 1% when COVID
Right.
news actually finally breaks. And stocks are kind of continuing higher there. That's when that opportunity, that divergence kind of brings about a potential trade. Now, the question becomes, Pete, is this an opportunity for reversion, or is this a revolution within markets? Because every time this happens, there are a group of people who just say, oh, yeah, yields are going to be stuck at zero forever,
Right. The
and
new
stocks are going to
normal.
climb
Yeah.
forever because it's the new normal. Is that something that you mess around with, or what?
You know what? I think putting context around movement 30 years ago and movement now, it's dangerous to overlay that set onto our set. We're not doing that. So no, I think that's an excuse when you've run out of patience. When the correlation, when the pair you're looking at, the two asset classes you're looking at, haven't moved in quote unquote the normal or a convergence fashion, it's like, well, we're in a new norm. This is the new paradigm. I don't know what that means. I mean, if we break it down again, companies thrive on capital. This is their lifeblood. Everyone is leveraged. And when I say that, it's not like everybody is just trading leverage, but the borrowing of money, the lending of money is leveraged. No bank has the amount of capital within its books that it loans out. It's all a system of, so the cost of that capital plays through everything that we look at, trade at, and live with. So will it have an effect on the performance of equities? Absolutely. Does the performance of equity have an effect on the cost of capital, and i.e. the interest rate? Absolutely. Can't get away from that fact. That is a fact.
Yeah.
It's just the lifeblood of the mechanical way that companies and economies work. So the idea that, well, this is just a new norm. I mean, you can, the fear concept is that they borrowed so much money at such low levels. If rates ever actually go higher, the cost of servicing that $16 trillion of debt will make it impossible for the government to pay for anything except that debt. Again, that's an academic argument down the road. I think that patience is the watchword in plays like this, and this is where true opportunity lies.
Yeah, it's funny. This is something that I and so many other traders have made a point, like almost like the central strategy to the way that I think and so many people out there, which is like the minute that someone says this is a new normal, or like we're in this crazy environment, or like this is an outlier event that is just going to exist now for perpetuity, it's like I want to get on the other side of that almost instantly. Yeah, because like you can only fear exists in this manner, whether you're trading options and you're looking at VIX, or you're trading, futures and you're looking at these divergences, whereby, of course, theoretically, divergences can occur into perpetuity. And economists are out there making those debates because it is sexy to make that debate and then put it online and get a bunch of views. But almost always the stuff comes back. Like, I don't know of anything where there's such a huge fundamental shift, Pete, and then we just live in that shift forever, especially one so essential to the economy. So how do I trade this thing? Well, it's as easy as crunching a couple numbers that I've laid out here for you using the SM75 futures from the small exchange and the S10Y futures from the small exchange. That's a great stock market and interest rate market there. Yeah, and I threw some stats up there. These markets move in the same direction about 65% of the time. They have a volatility ratio of about 1 to 2, meaning that 10 years are about twice as volatile as stocks. I factored that into our equation here, got to a ratio of current price points in those markets. And the $100 simple multiplier from the exchange, 1, 2, 3 short SM75 to 3 long S10Ys. This is one that we love to talk about all the time, but I wanted to give a bunch of context to, because it's one that we love talking about because it occurs so infrequently. And until we have that fundamental shift that does exist on into perpetuity, it's one that has come back time and time again. So reversion versus revolution, I'm almost always on the reversion side now. If we do.
Absolutely. Timing is often the challenge, but the percentage, we can't get away from that 65% number. This is the areas where we continue to use stats as stats are our edge right now. It used to be standing in an octagon with 200 knuckleheads, and it was a great edge. This is now. Stats are our edge in the world of static delta futures.
Absolutely.
So we'll continue to use them and play them. And it's a great piece of context, Frankie, laying it out, especially, it's so easy to get granular as to what did the chuckleheads say in their press release, and worry about a change in a sentence. You'll hear the other corresponding chuckleheads talk about this. The market will tell you exactly what that statement says. You don't need to read it. And the opportunity lies in opportunities like we just talked about, sure, not in parsing through statements.
For those who don't know, he's talking about central bankers, and actually we have a group of central bankers here in the U.S. who are about to speak in about 20 minutes. So we need to get out of here. We're going to join you for Splash into Futures coming up next and do a rapid fire scalping zones for the big FOMC event that's about to come up. So stick around for that. Thanks for watching, everybody.